All right, all right, all right. How's everyone doing today? Yeah, saw something in here from the humble accountant. First and foremost, welcome to the Gross and Loan stream right now. We're going to be streaming the Opendoor investor call. That is my biggest holding in the stock market. So very excited. Yeah, welcome back, Brogan. I do a stream every day in the morning. So 2 streams today, 2-for-1 special. Opendoor is the company I'm most bullish on out of any company in the stock market right now. Really excited for their first earnings report right now. The call does not start until 4 o'clock, so you are correct in that, the humble accountant. Don't want to throw anyone off there, that's why I put it in the title, but do want to just clarify. The call starts at 4 o'clock. They did drop their earnings report not too long ago, so I'm going to go ahead and go through that, crunch the numbers really quick, and yeah, see what we're looking at going into the call. But as you can see, we are ready to go over here. We got our seat reserved. Once the call starts, I'm going to shut the hell up and let them do the talking. Oh no. Yep. So we will know as soon as they go live over there. In the meantime, I'm going to pull up their earnings, or their filing, I'm sorry. Just looked at it briefly on my phone. I'm going to crunch the numbers over here. From what I was reading in the overview of their filings, I saw a lot of great things in there. I saw an increase in profit margin. I saw beating their expectations or the projections for Q4 ever so slightly. I saw that they plan to double the amount of markets they're in 2021. Great for us. We're really, what I've been looking for over here, because I think it's a phenomenal company. I think what they're doing is, truly the future. What I'm looking for in these calls is I want to make sure that our net income, our bottom line, it continues to close that gap from being unprofitable to being a profitable company. Yes, that is exactly correct, humble accountant. Is the conference call? Let me see if I can click on this. Yeah, nope. If you guys haven't already, please smash that like button, smash that subscribe button if you love Opendoor. I love Opendoor. Everyone who's in here right now, who's a recurring viewer, they'll tell you this. I've been bullish on Opendoor since September. On their IPOB still, by far the biggest position in any of my portfolios. Pull that open. But yeah, if you love Opendoor, so do I. We'll get along well. Smash that subscribe button for me, please, folks. Smash the like button at the very least. Don't ask for much, but that would be greatly appreciated. And if you like this kind of content, I'm going to crunch the numbers really quick. This is something I do on the stream every day. I also go SPAC hunting every day. So if you like SPACs, I love SPACs. Ring the little bell next to that subscribe button so that you can get notified every time I drop a new video, every time I go live on here with a stream, and we're making money up in here, which is every single day the stock market's open. Now let's crunch the numbers, folks. I'm going to pull this over here. Just know every single number you see in this sheet is going to be coming from that web page you just saw. Our current stock price, I know we took a hit today along with every other company in the market, but I'm not really worried about what our price is today. This is a 10-year hold for me, at least. Unless I hear anything that changed my mind otherwise. 24.38 is what we closed at. Down another $4 since yesterday. That's okay. More opportunities for us to buy in. $14 billion market cap currently. We'll report again. These are going to be reflected in thousands. We'll add 3 zeros at the end. Current period. Go. Last end of 2019, we had a little bit more. Down about 56 million on the year. We have reduced our liabilities, however, substantially. Promise, if anyone's just tuning in right now, this dude's gonna shut up as soon as our Lord and Saviors over at Opendoor start talking. When do I think the Bulls are coming back? I don't know. I hope they stay away for a while, to be honest. I'm just looking to just continue building more assets into my, or buying more assets for a bargain price right now, because I don't think the crash is here. We're about to get another stimulus that's going to pass eventually. We'll see when it does finally pass. But as soon as that happens again, more money enters the economy. They just keep printing money for us. Actually, checked inflation last night again today. Inflation is down compared to the same time last year, which is very surprising. So I don't think the real crash is here yet. I think this is a correction. The longer this correction goes on, though, the more confident I am in the next bull run. We need a nice consolidation period because we spent so much time going straight up like this. Also, if you guys are just joining for the first time, I am not a financial advisor. I am a professional online marketer. My father is a financial advisor. That does us no good. I cannot legally give you advice. This is all self-taught knowledge from entrepreneurship. So, that being said, we've spent a lot of time going straight up like this, and the steeper we climb, the steeper we're going to fall. So we need to go through periods where we go like this, and then we go like that, right? And then you go like that. That's healthy growth, and you want to have some pullbacks, and basically just make a higher floor than you had last time. I'm not explaining anything new to you probably, but that's what we need. So I hope that this correction goes on for more than just this week. I know it's been going on since last week, but ideally, if we can go like another week, I know everyone who has options is like, no, we can't do another week. I don't trade options. I'm a long-term investor. I am the only 25-year-old value investor in the entire world. So I'm okay with it. Like, it doesn't matter to me if the stock market's down today, up today, if it's closed for the next 3 months. My positions aren't going anywhere. I'm very confident in the companies I hold. And, I don't hold a lot of companies. I just load up more shares of those companies when I want to invest. And every time I'm looking for a new play, would I want to spend this money on entering this new position or adding to my existing positions? And more often than not, it's adding to my existing positions. So I don't know when the bulls are coming back. I would imagine as soon as there's a stimulus that passes, that's probably when the bulls will enter the market again. Or they'll probably catch wind of it like slightly beforehand when the smart money catches wind of it, and then they're going to enter the market again, if I had to guess. All right, this is good for shareholders right here, what you're about to see. Oops, that is not the right number. That's more like it. And same time last year, end of 2019, here's what we're looking at. So our stockholder equity has increased by $2.3 million in 1 year. Great for shareholders everywhere because we reduced our liabilities by a whole lot of money. Outstanding shares, we'll grab that in a second. Yeah, don't look at your portfolio. If it's down, just don't look at it. I haven't looked at it for a second, and when I did yesterday, I was like, ah. But when you guys, or when I get a bunch of Robinhood or E-Trade notifications on my phone, or y'all start telling me that the market's coming back, then I can take a peek at my portfolio and I'll be happy again. Otherwise, I'm just going to be ruining my day. All right, let's get to the revenue. Top line, 248. This is in thousands also. Revenue is down, but I think anyone who's been playing Opendoor knows that. Expected Q1, I think, is going to be a really good earnings report. I've been seeing a lot of stuff. I get notifications every time they file anything. I get notifications on Twitter every time they tweet anything and they hire someone new. I get notifications all over the place for Opendoor because I love them so much. So I've literally had this call on my calendar for the past month in preparation. They've been doing a lot of great things in Q1 that I've been seeing. Already expanded into 2 new markets, like we said earlier in this stream. They are projected to, or they're expecting to double the amount of markets they're in by the end of 2021. Phenomenal for us. We're looking to get to 100 markets or 100 major markets as quickly as possible and get at least a 1% market share of them. That's going to help our money grow really fast. And I think that's what's ultimately going to help Opendoor just conquer this market. They're already beating the shit out of Zillow right now, so I'm not too worried there, but we just want to keep expanding that lead on them, not give them or any other player time to catch us. Because if we can win the $1.6 trillion annual residential real estate market, we're going to be very, very happy that we invested in Opendoor as early as we did. That income, that's always the area of concern. That's the one knock that Opendoor gets, and I totally get it. But I'm not really too concerned with it here. As long as we can continue shrinking that gap, which you'll see in Q1, I think is where you're going to really see that gap shrink, or I guess profit margins increase in our favor, just based on what I've been seeing, how many services they're starting to bring in-house. All right, so we did net income of negative 87.72. Yeah, I mean, I think in my mind, Job, this is a $100 plus stock easily within the next, I mean, in my mind, it's going to be quick, but next 2 to 3 years, I'd expect it to be over $100. And yeah, a market crash could change plans there, but long term, I think this is a very strong company. I love the people attached to Opendoor. Keith Raboy is one of the most respected growth minds in the world. This has been his idea since he was at PayPal, founding that back in 2003. He had presented to Peter Thiel at that point. He's involved. Obviously, he's been an early investor since 2014. You got Chamath, my boy, my Lord and Savior, who brought us Opendoor through IPOB. He was in charge of user growth at Facebook from year 1 onward. He was in charge of user growth at AOL, specifically for the AIM sector. And I think all of us probably had AIMs back in the day, right? So he knows how to grow stuff. He's got an incredible network. Keith knows how to grow stuff. He's got an incredible network being part of the PayPal mafia. 1722. So yeah, there's so many great people attached to this that just know how to grow companies and grow them better than anyone else in the world. Then you've already got an existing lead. then you take into consideration that they've got a large amount of existing revenue when they're doing $2.5 billion of revenue on a bad year. And you've got companies that are pumping into the 60s. I always harp on this one. I'm sorry, guys, but CCIV, Lucid Motors, pre-revenue company that got run up to a $92 billion valuation when the merger was finally announced. So, you know, these companies in this sector, like Zillow, they traded about 6 times um, what their enterprise value is, or what their current valuation is. So. Um, Here, I think that they did price their value, or they gave them the enterprise value of 4.7 billion with IPOB based off of 1 year of revenue just last year. So let's just take that into consideration. If they get up to $50 billion of annual revenue, which I think they can do relatively quickly, as long as we get to 100 markets quickly, that's when you're going to really see the true growth of your share price rise. 50 billion times 6. Not saying that's how it's going to play out exactly. That's how I see it playing out, though. Looking at $300 billion, when today at $24 and whatever cents, we're trading at, I think it's a $14 billion market cap. So how many times 14 billion goes into 300 billion, multiply the current price by that, and that's what my target is when we're finally at that point of being a $50 billion annual company. They had in 2019, Brogan, they had a $4.7 billion annual revenue. Yes. Okay, let me finish this out really quick. So we'll see below what our profit margin's looking like. I think Q4 we might have gone backwards, but let's see. Yeah. So we were at negative 7% before this year because I'm assuming they took some hits probably in the beginning of the year. We're looking at negative 11%. Oh no, it looks like Q4 was our least profitable quarter yet. So something to keep an eye on. I wasn't really, I mean, I'm always looking for it. This isn't really a huge red flag about Opendoor for me. Yeah, it's not a huge red flag for me. I'm really curious to see what their Q1 results are going to look like, just because I'm literally getting notifications every day about new moves they're making, new ways that they're driving revenue, and I'm curious what they're going to say on this call about this number, because I mean I'm sure they know they have to address it if profit margin has been smashed like that. It's because the revenue is way down this period. Revenue in Q1 they're projecting to be around $600-700 million, from what I read. So something to keep an eye on. Let's go look at outstanding shares, and then we'll have a book value per share. $178 million. Our book value per share is $8.94, and we are trading at 2.73 times what our book value per share is. If you're not familiar with book value per share, you know, it's not the only indicator out there. There's tons of them. It's one that I love to use, though. I'm always looking for intrinsic value in companies, which is why I invested in Opendoor in the first place. Based on our shareholder equity, subtracting the preferred shareholder equity, I'm just going to double check, make sure that that's 0. Yep. No preferred shareholder equity, so you take the total shareholder equity, you subtract preferred shareholder equity, and then you divide that outcome by the number of outstanding shares, so 173 or 178 million, whatever we entered below, and it gives you $8.94. This is based on the balance sheet, which is always going to be, or assets are always going to equal total liabilities plus total shareholder equity or stockholder equity, depending on what sheet you're looking at. Synonymous. There's no difference. I will be pulling up the Opendoor call over here as well. Don't panic, my friends. We've got it ready to go. We're not going to miss anything. Boom, right there. We're not going to miss anything. But yeah, they're saying it's worth around $9 a share right now. trading at 2 or price to book ratio is just what this is relative to what our current price is. Anything under 1 is considered to be 100% undervalued currently. Anything under 3, there's a very likely chance that it's currently being undervalued, and only up from there. So this is what I would deem undervalued at this price, 24.38, where I'm probably going to want to go load up on more next week as well. So there you have it. There's Opendoor's earnings. Really interested to hear what they have to say, because those guys are way smarter than I am, and they run the company every day. They're in the know. So I'd like to see where they're at. In the meantime, we're just going to chill here. Leave this open. Make sure we don't miss anything. And then y'all ask any questions you want in the chat. Let's see, and catch up over here. Probably once all these earning reports stop happening, maybe longer. Honesty, all in on a Cardano staking pool producing 5x yearly and dip. I am 35, got it on the 30 last week. My average price right now, because I've averaged up along the way, I'm sitting at $16 per share. My first purchase was when I was at like 11 bucks. Maven Marketing Group, great to see you as always, my friend. So yeah, I'm at around $16 all said and done. And I'd like to go add more, honestly, so I can increase my equity in the company. See, Open has $3 billion of revenue and a $4.x billion valuation. They have $4.7 billion valuation. I think I touched on this a little bit earlier, Rogan. I just want to make sure I catch up fully in the chat. But $4.7 billion valuation based on their 2019 revenue, which was $4.7 billion. They did 4.5 times the number of transactions that their nearest competitor, Zillow Offers, did. And Zillow was so unprofitable that, from my understanding, they had shut it down temporarily. This was back in Q3 of 2019. I think they have resumed it since then. Be interesting to see what they say in here, though. But yeah, I'd say it's overvalued or undervalued currently, still, even at $14 or $13 billion market cap. You just saw the book value per share. Yeah, today was tough for everyone. I'm not even looking at my portfolio. We lost $4 on Open. I'm not too worried there. You're not going to shake these shares from me. I'm in for the long haul with Open. This company, you're going to be seeing about Opendoor, or reading about it, hearing your friends using it for years and years and years to come. It's only going to become more prominent. So I'm not going anywhere. I'm going to be very happy that I didn't 5 years from now, I'm sure. I don't know why it wouldn't be moving much after hours. There's a lot of money getting shuffled around right now in the market, from my understanding. So, like I said, I'm not even looking at Opendoors today. I just saw a second ago. That they are at $24 right now, which is crazy to think, because we were just at 30 whatever how many weeks ago. Oh yeah, eventually, once they get to enough markets in the United States, that's the most important thing first. We don't want to spread out too quickly. Yes, sorry, just saw the G on anything. You don't want to spread out too quickly, because then you leave your home territory to be conquered by someone like Zillow, someone like Redfin, or drawing a blank on the other competitor we have. We want to conquer this first. That's why I said it's all about how quickly can we get to 100 markets. If we double in 2021, like they're saying they're planning on, we should be in about 50 markets by the end of 2021. With a 1% market share of that, we're going to make a lot of money. Obviously, the end goal is we want to get to 3 to 4% market share. If we can get to 3 to 4% market share of all the markets we're in, and we get to 100, we're going to be printing money over here. We got nothing to worry about. They're only going to continue expanding their reach as well from that point on. And yeah, let me just refresh this, make sure we don't miss anything. It's 4 o'clock. I'm going to shut the music off in the meantime. I'm going to have to give you guys desktop audio. Hang on, because I'm going to plug in with my phone if that's the case.
Contains forward-looking statements within the meaning of the federal securities laws, including but not limited to statements regarding Opendoor's future financial results and management's expectations and plans for the business. These statements are neither promises nor guarantees and involve risks and uncertainties that may cause actual results to differ materially from those discussed here. Additional information that could cause actual results to differ from forward-looking statements can be found in the Risk Factors section of Opendoor's annual report on Form 10-K for the year ended December 31st, 2020, and Opendoor's other SEC filings. Any forward-looking statements made in this conference call, including responses to your questions, are based on current expectations as of today, and Opendoor assumes no obligation to update or revise them, whether as a result of new developments or otherwise, except as required by law. The following discussion may contain non-GAAP financial measures. For a reconciliation of each of these non-GAAP financial measures to the most directly comparable GAAP metric, please see our website at investor.opendoor.com. Now I will turn the call over to Eric. Eric?
Thank you, Whitney. Welcome and thank you all for joining our first earnings call. Before we get to the results and momentum we're seeing, I'd like to take a few moments to ground us in the importance of the problem we're solving. At Opendoor, our first core value is to start and end with the customer, and we are relentlessly focused on improving the customer experience. We share customer story at every board meeting and every all hands, and I want to extend that same tradition today with a story about the Cummings family and their experience with Opendoor in their own words.
Hi, my name is Rhonda Cummings, and this is my husband, Dominic. We're from Jacksonville, Florida. We found ourselves in a situation where we needed to sell our home quickly. This happened because of the placement and subsequent adoption of our son. We were a family of 4 in a 3-bedroom house, and when we got our son, we realized that we had quickly, and I mean quickly, outgrown our 3-bedroom, 2-bath. And I knew as the chief mom officer of this family, it was time to get moving. We didn't necessarily have the time or the patience to find a realtor, list our home, do repairs, and everything that comes with that. And that's why Opendoor was absolutely essential in getting my family into a home that was going to grow with our growing family and our needs. They saved us time, they saved us money, and that is absolutely invaluable. My husband's going to explain to you some of the details that he found helpful as he's the chief financial officer of this family.
I also didn't have to worry about hiring a contractor to fix things around the house, nor did I have to worry about listing the home or showing the home around with 3 toddlers and a teenager. So with that being said, this process provided us so much ease, and we're very thankful for that.
So from the chief mom officer and the chief financial officer, thank you, Opendoor.
Thank you.
And special thanks to Dominique and Rhonda for sharing their story with us. And we are inspired by the impact we can have for families just like the Cummings and chief mom officers nationwide. That being said, For the vast majority of the 5.6 million people who buy and sell a home every year, this process is still far too complex, stressful, and time-consuming. Less than 1% of transactions are online, involve dozens of steps, and span multiple months. So I founded Opendoor in 2014 to build what consumers crave and deserve, a simple, certain, and fast online experience. We are making it possible to buy and sell a home at the tap of a button. As the inventor and leader in this category, we have helped over 80,000 families move, totaling over $20 billion in transaction volume. And as we have scaled to over 20 markets, we've done so with profitable unit economics. We pride ourselves on doing the hard things first. Vertically integrating the entire experience and rebuilding each component from the ground up is not easy. But it is necessary to remove the friction and cost that exists in the transaction today and deliver on what we believe to be the best customer experience. So, for the past 7 years, we've done the hard work to refine the product, pricing engine, technology platform, and operational systems so homeowners can buy and sell in just a few taps. As I reflect on 2020, it was a turbulent and unprecedented year, but I'm proud of how our teammates supported each other, focused on our mission, and continued to invent and build for our customers. In terms of results, we finished 2020 with $2.6 billion of revenue. While this was lower than our 2019 levels due to our pausing acquisitions at the onset of COVID, we saw strong margins, with adjusted gross margins of 8.2% and contribution margins of 4.3% in 2020. In Q4, we delivered $249 million of revenue, with gross margins at 15.4% and contribution margins at 12.6%. As we enter 2021, I feel like we've been building Opendoor for many years behind the scenes for this very moment. First, COVID has reset how consumers think about their home. Home is now also the office, the gym, the school, and if you're lucky, your favorite restaurant and date night. Before the pandemic, 12% of full-time employees worked from home. That share is now up to 42%. Additionally, in a recent survey, 28% of respondents decided to leave their city as a result of COVID-19, and an additional 25% are accelerating their plans to move for the same reason. The ability to work from almost anywhere, wanting additional space, and low interest rates has created historical demand for residential real estate. Second, the adoption of digital products is rising sharply. While the impact on food delivery, transportation, and e-commerce is most visible for us day to day, real estate is no exception. In a recent survey we conducted, 71% of sellers said they would consider selling their home to an iBuyer. These two seismic shifts have created significant tailwinds for us. First off, more and more home sellers are coming to Opendoor to request an offer to sell online. So far this year, we are sending over 50% more offers per month compared to this time last year and exceeding previous highs. What's more exciting is that we are converting more and more of these home sellers. A question we often get is if homeowners will choose Opendoor when the markets are hot, like we're seeing right now. The answer to that is yes. Our seller conversion is exceeding historical highs. And most importantly this year, our seller net promoter score is trending over 80, which is up 10 points from 2020. We believe this is the future of real estate and is coming faster than expected. Next, let's talk about our upcoming plans. Our goal is to be the best place to sell a home online and seamlessly move. That means we are focused on 1, driving market share of sellers in our existing markets, 2, expanding to many more markets nationwide, and 3, building our digital one-stop shop to seamlessly move. First, we continue to expand our ability to address a wider range of sellers in our existing markets. In Q4, we expanded our buy box by 35%, increasing coverage in price, zip code, and home type. These buy box improvements, plus increasing offer requests, plus record high conversion, give us confidence in our ability to exceed historical market share levels. Second, we plan to double our market footprint this year from 21 to 42. Our operational systems, pricing models, and launch playbooks have been tested at scale and are underpinned by our technology platform that automates and centralizes the transaction. Thus, we are positioned to rapidly and profitably expand nationwide, and we are well on our way, with 6 markets launching in Q1 including recently announced Asheville and San Diego. Long term, we plan on being live in more than 100 markets and servicing over 70% of the homes in the U.S. Finally, we will be making progress on our goal to build the digital one-stop shop to move. We've already enabled homeowners to sell online in a few minutes and provide tech-enabled title insurance, escrow, and mortgage services. Yet, we know that 2/3 of sellers are also buyers. So we are building a one-tap buying experience so customers can buy and sell seamlessly. Accordingly, we recently launched cash offers for home buyers, which enable home shoppers to submit an all-cash offer backed by Opendoor, select their preferred closing date, and line up their move. We know the market is competitive, we know buyers want to improve their chances of getting their dream home, and we know sellers want certainty and speed. This feature, and more to come, demonstrate our ability to innovate quickly based on what we're seeing in the market and leverage our expertise in technology, pricing, and operations. In closing, we are relentlessly focused on building a frictionless and digital experience for consumers. It is this focus, coupled with our technology platform, operational scale, and seasoned team, that will enable us to be the pace setter and deliver an online, delightful experience for millions of homeowners nationwide. With that, I'll hand it over to Carrie.
Thanks, Eric. As Eric just discussed, we had a solid finish to 2020, and we're pleased with our momentum going into 2021. We reported revenue of $249 million and an adjusted EBITDA loss of $27 million for Q4, and revenue of approximately $2.6 billion and an adjusted EBITDA loss of $98 million for the full year, exceeding the targets we provided last fall when we went public. As we've discussed, our results for fiscal 2020 were materially impacted by COVID. The onset of the pandemic caused us to pause home acquisitions beginning in March due to unprecedented uncertainty and safety concerns, and to actively manage our balance sheet and sell in the vast majority of homes we owned over the second and third quarters. We sold almost $1 billion of inventory in that time at constant margins, demonstrating the agility and resiliency of our resale systems. However, given that inventory is the fuel for revenue, that sell down impacted our top line in Q4. Declines notwithstanding, we did exceed revenue expectations that we put out for the year. Q4 revenue performance was driven by strong market demand for housing and the strength in our resale processes. Q3 marked our low point for inventory, and we have been aggressively acquiring homes since that time. We purchased more than 2,000 homes in Q4, which reflected a strong acquisition ramp throughout the quarter. We ended the year with $466 million of inventory, representing 1,827 homes, which is up over 3x on September's balance. On the margin front, both adjusted gross profit and contribution profit were strong for the full year and particularly strong for the fourth quarter. Adjusted gross margins were 8.2% for 2020, up 190 basis points from 6.3% in 2019. Contribution margins were 4.3% for 2020, up 230 basis points from prior year. And on a per home basis, we generated adjusted gross profit per home of $21,000, contribution profit per home of approximately $11,000. For Q4, we saw adjusted gross profit per home of approximately $45,000, contribution profit per home of $37,000. These higher margins were largely driven by having a healthy inventory mix weighted to recently acquired homes, as well as from strong home price appreciation in our markets. From an adjusted EBITDA perspective, we had a loss of $27 million for the quarter and a loss of $98 million for the year. We saw gains in adjusted EBITDA, driven primarily by the increase in contribution profit, but also as a result of the cost controls and expense reductions we undertook in response to the pandemic. Our operating expenses, which comprise the delta between contribution and adjusted EBITDA, were $59 million in Q4 and $208 million for the full year, down 24% and 33% respectively. While absolute spend declined, we did see deleveraging of OPEX in both periods given the lower revenue base. I'd also note that Q4 OPEX, while down year over year, did grow 43% sequentially as we resumed operations across all of our markets and accelerated investment into sales and marketing, operations, and product development to support our 2021 growth objectives. I'll now turn to our quarterly guidance. We are not providing updated annual guidance. However, I can say we are comfortable with our previous outlook for 2021. We've also previously talked about the cadence for this coming year. As we rebuild our inventory, we expect our top line to follow, meaning that our revenue will be weighted to the back half of the year. For Q1, we expect revenue of $600 to $625 million. Adjusted EBITDA losses are expected to range from negative $33 to negative $28 million. On the revenue side, we're encouraged by volume trends in our business due to both our increasing acquisition pace and increasing top-of-funnel demand. In addition, we expect that strong market home price appreciation, or HPA, will continue to positively impact revenue in Q1. With respect to unit economics, the strong margin performance we realized in Q4 should be considered temporal. While we do expect margin tailwinds to persist into Q1, they will moderate throughout the year, beginning this next quarter. Let me tell you about why. First, as we build up our inventory balance, our resale mix of homes will normalize throughout the course of this year. Second, while our pricing models were responsive to the very strong housing macro we saw in Q4, we did realize upside relative to our underwriting, particularly for homes that we underwrote in Q2 and early Q3 and subsequently sold in Q4. Going forward, we expect that our margins will moderate as we move throughout the year. I also want to note that we do expect to see a significant increase in non-cash stock-based compensation expense in Q1, estimated at approximately $235 million. This is much larger for us than a typical quarter and is due to our recent public offering. The expense is primarily related to historical equity grants to employees, as well as for additional performance-based equity grants. We expect to continue to recognize additional stock-based compensation expense going forward over the remaining time-based vesting periods for these awards. Now turning to the balance sheet. As of the end of Q4, we had approximately $1.5 billion of cash and marketable securities. The follow-on offering we did added another $860 million, bringing us to approximately $2.3 billion. We are well capitalized and have substantial firepower to invest in market expansion and other opportunities we see to accelerate our business and product roadmap. In conclusion, while 2020 certainly presented many challenges, we're proud of how our team managed through a very difficult year, and we're pleased with how we wrapped up Q4. In addition, we're encouraged by the momentum we're seeing going into Q1, propelled by this undeniable shift in real estate from offline to online. We'll continue to build upon our track record of posting positive unit economics as we drive growth over the course of the coming year. And with that, operator, we could please open up the lines for some Q&A. Thank you.
Certainly. As a reminder, to ask a question, you will need to press star 1 on your telephone. To withdraw your question, press the pound key. Please stand by while we compile the Q&A roster. And our first question comes from the line of Yanni Yadgarin with Credit Suisse.
Hey guys, thank you for the questions. So two from me. The first is around just the kind of cadence and gating factors for the rollout of maybe new services as well as potentially expanding your footprint within home loans, etc. How are you guys thinking about that? What are the kind of the main kind of factors that go into that between investing in the engineers, etc., versus getting licenses or anything else that might be involved on the partner side to kind of roll out incremental services. Secondarily, we just talked here. What are kind of the puts and takes that might impact the quarterly cadence of gross margins in particular throughout the year? Particularly, on your comments around appreciating home prices. How much of that is a factor when you look back historically versus maybe new market rollouts and taking initial, bit more conservatism in how you price homes when you go into a new market? Thanks.
Thanks, Johnny. Hey, this is Eric. So I'll address the first part of your question, and then I'll let Carrie address the second part of your question. Yeah, as I mentioned in the remarks, we're really focused this year on investing in 3 big areas. So the first is to deepen our market penetration and expand in our existing cities. The second is to expand nationwide, and we are launching 6 cities in Q1, and we're aiming to be at 42 by the end of this year. And the third big vector is building the one-stop shop. We know that 2/3 of sellers are also buying another house, and we want to make that transaction extremely seamless online and digital. In terms of edge resources, we have the capabilities and the staff to invest in all three vectors, and we're going to be driving additional improvements down all three this year.
Great, Eric, and if I can take the second part of that question, just around expectations for the cadence of margins through the course of 2021, I think was the question you asked. If you think about what drove margins, first of all, in Q4, that'll help us talk about what's going to happen for the coming year. Really two main drivers of margins. One was having a very fresh book of inventory consisting almost entirely of newly acquired homes. That was one. Second driver of margin in Q4 was around a combination of the underlying market strength we're all feeling today, coupled with the timing of home acquisitions. So the homes that we sold in Q4, just as a reminder, are actually homes that we offered on and we acquired in Q2 and early Q3. And so that gap in timing realized better than anticipated HPA gains, and you're seeing that benefit in margins. Both those drivers will not persist at the same rate for the balance of 2021, which is why our caution in my comments was to just to call out the fact that we expect margins to moderate over the course of this year. Certainly, as we acquire more inventory throughout the year, that distribution of homes in terms of aging will just look more normal. And then in addition to that, our underwriting today of homes really reflects what we're seeing in the market. Well, we may have been intentionally conservative in our underwriting rate last year, just given the volatility in the market due to COVID and other reasons. Today, we've adjusted to the environment. We feel very good about the drivers to HPA that we're seeing right now, and our underwriting reflects that. So you'll see that in margins that will come down over the course of the year from where we are today.
Got it. Much appreciated. Thanks, guys.
Thanks.
Thank you. And our next question comes from the line of Jason Helfstein with Oppenheimer.
Thanks. Two questions, and I apologize in advance for the comparisons with Zillow. You should be you should be analyzed on an absolute basis, but we're living in a very relative world right now in the stock market. So when I think about your first quarter revenue guidance, very similar to Zillow, should we be thinking about this as a duopoly? And just generally, when you think about the experience you're giving consumers versus Zillow, do you see differences today? And then I guess second, your margins are much better than Zillow. Could you grow faster if you extended losses or pushed down margins? And just how are you thinking about margins versus growth over the next 2 years? And I know we have obviously your previous guidance, but maybe just give some color how you're thinking about the balance between those two. Thank you.
Yeah, I appreciate the question, Jason. Maybe I'll start off by reminding us that less than 1% of transactions are online, and when categories are forming, raising consumer awareness is a net benefit, especially when the product is this much better. And we do see really great conversion right now. So my view and our view is that as more and more transactions move online, just given what we've built to date and our operational processes and the platform we've built, we feel very well positioned to be a market share gainer in the coming years. With regards to competition, will we need to compete over time? Sure. But again, we're focused on building the best consumer experience and very confident in our ability to compete. Carrie, do you want to speak about the margin?
Yeah, Jason, your question is about those trade-offs between growth and margin. What I would say at a high level is really first and foremost, our focus is on maximizing the growth we have right in front of us and to take advantage of the enormous market opportunity. That's our number one objective. And we want to invest aggressively behind that growth objective. As evidence of that, I'd point to the fact that we just recently announced we're going to double the markets we're going to be in 2021. But we will continue to do that as we have historically with a disciplined approach to unit economics. Building a sustainable, durable business continues to be important to us. So I'm going to cheat a little bit and say and to your question. It's an and question for us. Growth number one, but always in light of making sure that we are disciplined on our margin objectives at the same time.
Thank you.
Thank you. And our next question comes from the line of Yigal Arounian with Wedbush Securities.
Hey, good afternoon, guys. Thanks for taking the questions. I wanted to ask Eric on your comments about conversion being stronger now than it has been historically and kind of improving there. And, I think that question makes a lot of sense. So maybe we could talk a little bit more about what's driving that in an environment where home sellers can kind of, go and expect to sell their homes much quicker than they normally would. And likely receive a bidding war on it and sell it above the asking price. So maybe just some of the dynamics there. And then second, would love to hear your comments on there's been some commentary in the market that you guys paused listings for about a month from mid-November to mid-December. So just is there any accuracy to that? And if that is what happened, maybe just some insights into why you made those decisions. Thanks.
Got it. Appreciate the question. So to your first question is what's driving conversion. I'll let Carrie speak to the second part of your question. But from what we're seeing is really two things. There's some macro factors I want to mention, and then some things we're doing on our side. The macro factors, as I actually already mentioned, was there is just a strong desire for a digital contactless experience. I'll talk about why in a second. And there's also just more demand to move. So if you can reduce the friction from the experience, then you can pull forward latent demand to move. But Opendoor, we're seeing an increase in organic sellers coming to the site, as I mentioned. We're seeing strength in our partnership channels, and those are growing nicely. We're lowering our fees due to the market conditions, and we continue to make constant improvements on our seller experience and product. And those things are driving the increase in conversion. When you think about the behavior itself, why are sellers selling to Opendoor versus listing on the market? And I would highlight two things. One is that even if it's a hot market, you still have to list the home, put in capital for repairs, have open houses, and wait the time. And that timing can be not necessarily flexible. And the second piece is that, again, 2/3 of sellers are buying another home, and so they need to be ready to move on the next home at a moment's notice. So having an Opendoor offer in their back pocket gives them flexibility to buy the next home on their timeline. So those are the two driving factors into the increase in conversion.
Part two of your question, just around the pause we took in listings late last year. I mean, without getting into the specifics, what I could say is, well, yes, we did that. We took the opportunity at that time to experiment with some of our own homes in terms of their listing. It seemed like a good time to, frankly, be doing it, just given seasonality. And I think you can expect us to once in a while experiment with the cadence of when we list and how we list, but nothing that I would over-rotate on with respect to that short-time move that we took. Short-term move.
Thanks so much.
Thank you. And as a reminder, ladies and gentlemen, to ask a question, please press star 1 on your telephone. Once again, to ask a question, press star 1. And our next question comes from the line of Edward Yrma with KeyBanc Capital Markets.
Hey, good afternoon, guys. Thanks for taking the questions. I guess first, just any commentary on any kind of funnel changes in behavior that you're seeing a little cuddled up with rising rates, and like if you're seeing any changes in behavior, maybe people even rushing to close. Second, kind of a broader question. I know you guys have a pretty comprehensive roadmap for adding more services and building that out. Any kind of update in terms of what the uptake has been in services and any change in that roadmap? Thank you.
Edward, can you repeat the first part of the question? You were breaking up a little bit.
Yeah, I was just asking, kind of based on this rising rate environment, have you seen any changes either in top of the funnel behavior or in the consumer kind of moving to close quickly, based on rates moving?
Got it. And the second part of the question is about our services roadmap?
That's right.
Got it. Yeah, so I'll address both, and Terry, feel free to opine as well. But rates moving and the desire to lock in rates now is certainly one part of the equation. But again, we see the stronger macro factors as the desire to move in a digital way, and the work from home policies changing, so giving people more geographic mobility. To your question around services, I think we've demonstrated a strong track record with title and escrow. We launched that business in 2017, and in 3 years got to 80% attached at very healthy margins. Back then we knew that consumers wanted an integrated close, and so we executed pretty well against that opportunity. We also know that consumers want additional services from us. We see this every single day when we talk to our customers. They do in fact want a more seamless integrated experience across multiple product lines. And so, we continue to invest pretty heavily this year in Buy with Opendoor. And as I mentioned, we just launched a new feature called Cash Offers within that product line. And then we're investing in Opendoor home loans this year.
Thank you.
I think that's sufficient. Can you repeat the second part of your question? I think you wanted to address the uptick we're seeing in services.
Yeah, I just wanted to know if there was anything you could provide in terms of attach rate, kind of quantitative color around the uptake in services.
Probably nothing more than we already supplied in our public filings, which is around title and escrow, which is the most mature of our service offerings today. We're attaching in north of 80%.
Great, thank you.
Thank you. And we have a follow-up question from the line of Jason Helfstein with Oppenheimer.
Hey, I figured I'd ask a little more. So any update on List with Opendoor? Any color or stats you want to share? Then a housekeeping question. Do you capture the homes that are in contract on the balance sheet or not until they close? Thanks.
Sorry, can you repeat the second part of that question?
Do you capture the homes that are in contract on the balance sheet or not until they close?
I can do the easy one first, Jason, which is we don't capture homes on the balance sheet until we own them, until they're closed. So what I would point you towards, if it's helpful, if you look at the 10K filing, what's in inventory is what we own. We do show homes that are under contract to be purchased. You can track that. So we had about 1,800 homes in inventory. We own those. We have about 1,700 homes, rough numbers, under contract to be purchased. They may not all close, but the vast majority of those will. So you can think of those two numbers as being more or less additive.
Okay.
Great. And with regards to List with Opendoor and an update there, maybe I just give you some color as to how we're thinking about the product holistically. We do want to be the best place to sell a home online. And a couple of things we care about is, one, we want to be on the customer's side. So that's kind of point number one. Point number two is that we do want to ensure that the customer is making an informed decision. And so by giving them the range of options, whether they want to sell to us to maximize convenience and certainty or list on the market, we do want to make sure they're informed of their choices and options, and then help them determine what is the best option for their situation. And so that's kind of the product thesis. We're seeing such strong conversion in our core offering, which is to sell to us, that's still the product line that's chosen the most. But as we kind of progress, we will continue to invest in List with Opendoor as an alternative to selling to us.
Thank you.
Thank you. I would now like to turn the call back over to CEO Eric Wu for any closing remarks.
Great. I just want to actually end this first earnings call by saying thank you to my teammates for their passion and persistence in servicing our customers every day. And I also do want to thank our shareholders for their support and our mission to transform how people buy and sell a home online. Thank you.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating, and you may now disconnect.
I'm pretty thrilled with that. A lot of numbers tossed out there. I'll have to go and probably listen to it again, honestly, later on tonight. Look at the earnings report again. We went over it briefly right before the call. Just wanted to import their numbers. At $24 a share, they're trading at only 2.75 times the book value per share. Right now, anything under 3 is typically considered undervalued in a lot of scenarios. And in this sector, tech sector especially, companies trade for a much higher multiple than, oh, thank you, Ben. They trade at a much higher multiple than 3x. Here now, it's not compared to book value per share, but they traded a much higher multiple relative to revenue, I should say. So, terrible Q4 in terms of revenue. Only 300, between $200 and $300 million in revenue in Q4. Let me get the exact number, so I'm not talking to my ass here. Here's our Q4 revenue, $250 million. That's obviously way down. We did $4.7 billion in revenue from 2019. We want it. They're really a real estate company when it all comes, when it's all said and done. They're the one-stop shop, which we know they've been aiming to create, or at least I've known they're aiming to create that. If they achieve that, they're going to make a shit ton of money, guys. But they're a real estate company. When the market took a shit back in March because of COVID, when you're invested in a real estate company, we need them to liquidate assets, right? If the market doesn't recover like it did this year, I don't think anyone knew at that time that it would recover like it did. We need them to liquidate their assets so that, one, we don't lose money, and two, we have a big pool of buying power for when, if the market never recovers and it really goes and it crashes and it hits a hard bottom, they can go scoop up all this real estate that I'm assuming they're going to buy foreclosures for, pennies on the dollar. They're going to buy homes off of sellers who are trying to sell their home for anything they can get because they were looking to move anyway. We want them to liquidate their assets in that case. So I expected revenue to be down this year. They were very transparent with it along the whole way. So this isn't really a surprise to any Opendoor shareholders. By the way, if you guys like Opendoor, I love Opendoor. Everyone who's here that's a repeat viewer, they know I've been preaching Opendoor since September. They know I talk about Opendoor every day. I stream every day the market's open, so smash the like button for me if you appreciate me hosting this call. Smash that subscribe button as well if you want to talk Opendoor some more, because I'd love to see you guys here every earnings call from now until the end of eternity, because I am never selling my fucking shares. But yeah, revenue is way down in Q4. That's okay. They already told you on the call they're expecting revenue in Q1 2021 to be between almost $700 million, which is going to be phenomenal. We're looking to double the markets that we're in. The gross profit margin, go take a look at that as well. That's something that stood out to me. We're not profitable, but the gross profit margin increased substantially since the same time period last year. I think a large reason that we're seeing the company goes so far in the red in terms of profitability is due strictly to growth operations, right? We're looking to grow the company. We want to scale. We're not taking our foot off the gas. We're trying to take down Zillow. If we don't take down Zillow and we take our foot off the gas, they're going to zoom right past us. But you heard on the call too, they are far more profitable in this iBuying business model than Zillow is. Zillow, they've got a nice cushion to work with, but all of Zillow's revenue for the most part comes from advertising spend. This is a platform that transactions can and will take place on. I believe that they're going to, bring a lot of things in-house, and they're going to have a true, I'd be very cool to see someone go through a full home purchase or sale and then repurchase of a new home straight through Opendoor's platform, which I'm sure they'll put out there because they've got good marketers. And when transactions are taking place on your platform, me as an online marketer, I know where the ad dollars go. You want to bring you want to send your ad dollars to the platforms that have the eyeballs, but they're even more effective on the platforms where you've got eyeballs and there's transactions taking place. If there's money that can take place, or money transactions that can take place straight through your advertisements, so you can get your listing above everyone else's on Opendoor, that's where advertisers are going to spend their money instead of spending it on Zillow, where there's not much transacting going on. So, keep an eye out for that. I'm sure the marketing team is going to do a good job there when, or if, and in my opinion, when that does finally occur. Thank you for that job. I appreciate it. Yep, you're going to get raw thoughts from me on this channel. I'm not concerned about it going red after hours. I'm not concerned about it going red, leading up to this. Everyone was kind of alerting me to that too, saying it's what's happening. I'm like, I don't know what's happening. I think it's fine, but I'm not planning on selling. Seriously, when I say 10 years, 10 years is a minimum. Well, I'll sit down and maybe reevaluate then. Unless I hear some big scandal come out and there's fraud taking place, then, I'm not an idiot. I'll sell my shares. But this is a really, really, really strong team. And being involved in entrepreneurship for almost 5 years now, I can tell you when we were raising money, my first company that I helped start, we raised nearly, it's not a lot of money, but nearly $1 million in funding when I was in college. And every single investor who would ever turn us down, they always would bring up the same cliche statement that they're looking to invest in the A plus team with the C plus idea. And really what we had was an A plus idea with like a D plus team, but they always finish it by saying we'd rather, that team, the A plus team versus the A plus idea with the C plus team. We were more like a D plus team. We were all, young, inexperienced. We're all doing great things now independently, but that's what we'd always got. So I try to instill that same investing principle amongst all my other principles, obviously, when picking a company. So when I saw this opportunity to get into IPOB and I saw everyone attached and I saw their core team, there's so much experience here, guys, that you can feel confident putting your money into this vessel, into this ship, and knowing that the captain and the co-captain and everyone else that are driving this ship forward are taking us to where we want to be, right? And there's not a lot of companies like this in the market right now. There's a lot of people investing in idea companies that grow quickly. They give you short-term gains. This one's going to be a long-term. The CFO is very strong. Yes, I'll get into the team. I can pull up their slides for you if you want me to as well. But I love this company. I'm gonna load up on more of it starting next week. I'm just waiting for my Robinhood funds to transfer into my E-Trade so I can load up on warrants. I love the warrant game. If you guys aren't familiar with warrants, we can go into that as well. But yeah, if you guys like this, I'll be doing this more often. I'll be doing this every time Opendoor has a call. Only portfolio companies I've got right now are Opendoor and Laser. I just sold out of my other one. And then, obviously Bitcoin and Ethereum as well. But I don't know if you guys are into crypto. I'm not here to plug my plays. But when I say I'm very conservative in my investing and I only load up my existing positions because I'm confident in them, I mean it. I don't add everything and anything to my bag. It's got to really earn a spot in there. Otherwise, I'm just going to buy more shares of what I already know, what I already love. And Opendoor is by far the biggest position I hold anywhere. So, yeah, what questions do you guys have? Let me see. I'm going to catch up in the chat. Smart chain. Even if it's red, exactly, Brogan. We are in here every single day. It don't matter if the market's red. That's when all the fake streamers go to sleep. That's when all the fake investors go to sleep. They can't bear to look about it and talk about it, or look at it and talk about it. What's Sandbox Crypto? I'm not familiar. Yeah, Open is not a sleeper. We do have quite a few sleepers on this sheet. I will be publishing this on my website for anyone who wants access to it. There's a lot of valuable information, a lot of sleeper SPACs on here as well. My position is nothing huge. I've got about 500 shares of the company, so not massive. I'm also 25 years old, so. But then you got Brogan in here, and Brogan's an absolute animal. He puts me to shame. So, but yeah, that's my biggest position in the stock market. As far as overall positions go, it's, Ethereum for sure is my biggest position. Yeah, as an investor, and Warren Buffett makes this great analogy where it's like you want to own companies, and you can tell I probably take a lot from Warren Buffett. I listen to Warren and Charles Munger talk all the time. I listen to all their old investor calls, because those guys, you'd be foolish not to take their advice. They got to where they are for a reason, and they say they want to invest in companies. They want to own companies that they could go on vacation for 20 years, come back 20 years later, and that company is still alive, and they are worth way more money than when they initially bought in, right? Opendoor is one of those companies. We got to keep our eye out for profitability. We do need to be profitable eventually, but we've got a very strong balance sheet. We've got $2 billion in assets currently. We just shrunk our liabilities by over $1 million. Our shareholder equity just went up from, so that's what our shares are worth on paper, for anyone unfamiliar. Our shareholder equity just went up from negative $700 million to $1.6 billion for a $2.3 billion swing. Yes, a lot of that has to do with them just going public through the SPAC. I think they got about $600 million from that, if I'm not mistaken. But our assets have gone pretty much unchanged. And our liabilities, that's the thing that blew me away, is they reduced liabilities by over $1 billion this year, which is phenomenal news if you're an investor. And that's what makes our shares as valuable as they are. And a lot of companies don't have shares that are this valuable, and they're trading for way higher clips than we are. Like, look at this one. This is Jumia. To this one right before I got off my stream this morning. Their book value per share is $3. They're trading at 12.5 times that. That's fully priced. $2.25 for Beam Global. They're trading for $40 today. Look at all these companies and how much higher of a clip they're trading at compared to their book value. And then you look at Opendoor trading at only 2.73 times what the book value is. These are two other good options here as well. We went over these. This spreadsheet goes on for a while, guys. That's why I want to be able to give you guys access to it. So I've been working hard with my web design guys to make sure we can get that up there for y'all. And it will be free. And I told y'all on the stream earlier, it's going to be free in the very beginning. I'm never going to charge you guys a single dollar, but as more people start to use it and it starts to take up more server space and I need to upgrade my servers for my site, that's when it's like, okay, it's costing me money now. You guys will never pay, but I'm probably going to put a paywall up then at that point. Just so you guys know the game plan and you don't feel like Mike is selling out at that point. It's literally just to cover my own cogs. So I got to run my business and make sure that I'm not sinking money just to be helpful. I'll sink my time all the time, though. I'll give you any time I can for free. What questions do we have? Huge investor in Open. Don't plan to sell either, but I'm disappointed with the after hours result. I put in 25 euros. Now you're at 650. It was a joke. Buy. But it's paying big. 15,000 shares. Oh my God, you're gonna be loaded. Don't sell those shares. These are going to over $100 a pop, and that's my conservative estimate. Don't give away your shares for free. It's not going to be long before, I think in the next run, because we've sunk into 24 guys, but my thought was on the next run, after this consolidation period, Opendoor is going to go over $40 for the first time. And I still believe that. So I'm not giving away my shares no matter what someone's trying to pay. Once it hits 100, I'll reconsider, reevaluate, but that's my target. I ain't going anywhere until it hits 100. Shamath and Keith or Boy are going to take it to that point. You can trust that. What else we got, guys? What other positions are we holding? What questions do we have about the call? Gross profit margin, that was my biggest takeaway, though, was that their gross profit margin was way up compared to the same time last year. And now the reason that our net income, our net loss in this case, is going further and further down is strictly for the sake of growth. Oh my God, 10 years from now. I can't even begin to fathom what the price is at. Let's just do some simple math right now, right? Let me pull up what it's at right now. I told you I do believe they will achieve $50 billion of annual revenue within the next 5 years if they get to 100 markets. It's all about getting to 100 markets. We'll expand from there. We'll expand internationally. When they go international, good fucking luck, Zillow. Company of the history. That company's history. That's why Zillow, they're willing to sink money into this project because they know if Opendoor wins out, their platform is toast. It's useless. 10 years from now, so we're at 24.38 at market close today. I don't know what we're doing after hours. If it's red, that's fine, but that's all we've got right now to go off of. I like to do market close price, not after hours price. So 24.38. Kathy will buy back in if she was selling positions, which I'm pretty sure she was because she was being forced to by the other funds, squeezing her out of positions or forcing her to reallocate her money. I'm sorry. 24.38 gives us a $14 billion market cap. Now we know that Zillow and the other companies, they trade on average for about, it's like 6 and change. We'll just call it, it could be 6.5. We can just do 6 for a more conservative because I don't know the exact figure anymore off the top of my head, but they traded about 6 times what their annual revenue is. And I'm sorry, their market cap's about 6 times what their annual revenue is. So at 2.5, I think was our revenue this year. It was $2.5 billion. This is a pretty healthy market cap, I'd say. You know, how many times does 2.5 go into? Pull up the calculator really quick. How many times does 6.5 go into? We're talking 2.5 go into 14. Sorry. All right, you got 14. Let's divide that by 2.5. 5.6, so it could go around 15, honestly. That's going to be pretty healthy based off of 2020's numbers. As we approach Q1's earnings being released in the next 3 months or so, they're making moves. Like I'm telling you, I get notifications every time anything happens with Opendoor. Well, there's an SEC filing, it's a social media post. They had just hired someone. You know, it's Eric Wu's birthday. It's Eric Wu's mom's birthday. I don't care. I want all the notifications. I get them all. I'm in the know. And they're releasing more and more stuff, and they kind of briefly glanced over it today on the call. Like they just entered 2 new big markets in this past week or two. Yeah, there's big moves happening, so I expect that the revenue for for Q1, if it is on par with what they're projecting, which is between 6 and 700 billion, or I'm sorry, 6 and 700 million. Closer to 700 million, though, you know, that's going to put us on par for a decent year. But we're not going to really see what we saw in 2019 until 2022, I still believe. So let's just multiply that by 4. It's going to give you right around 2.6. So same revenue this year. If the growth continues, though, you're not going to see $650 million across the board every quarter. As they approach, or as they enter and penetrate new markets, and as they increase their market share in their existing markets, this number is going to continue to increase as well. But it's very hard to predict what all those are going to be unless we had all the market financials in front of us for their individual markets. Now, if they reach $50 billion of revenue, like I believe they will, within the next 5 years, and you're trading, you know, call it 6, 300 million becomes what we can anticipate our market cap will be if it's like the other companies in the sector, if it catches up to it at least. Let me see how many times 14.08 billion goes into that. And then we'll multiply that by our current share price. That gives us 14 billion. And there might be other things that happen in here as well, like splits or offerings or whatever, and we'll have to account for that later, but we can't predict what we don't know. That is my realistic price target. And you might say, Mike, you're fucking out of your mind. And I'd say, I know, and I love it, and I ain't going anywhere until we hit at least $100. And at that point, I'm going to have much more confidence that we're going to actually hit $500 someday. Within the next 10 years, I can for sure see our shares being worth this somehow, some way. Maybe not 519 on paper. If we go through splits and we get more shares, I'm okay with that, but it will equate to over $500 a share from what we see today. That is my take on it. No analyst out there, no expert or professional analyst, remember I'm an online marketer, I'm not an analyst, is going to tell you that. And so, yeah, when I say I know I'm out of my mind, I know I'm out of my mind, but I'm okay with it. I'm in good company right now. All right, what else we got? Putting most of your money into Neo and Open. I'm not familiar with Neo. I've heard a lot of murmurs about it, but it kind of cooled down before I really dove into the market. Let's see, the Candy still, yep. You like, because you like money, George. George, I loved your show. I liked your show too. How do they see a 625 million next quarter when analysts are expecting 425 million? That is a huge spread. Can you explain why the big difference? That's a good question. Which analysts are expecting 425 million? That'd be good to know too, because I need to pull up, you know, whatever articles they're publishing that in, so I can really see what they're basing that off of, because I really trust, you know, Opendoor's team. They've been super transparent with the numbers this entire time since I've been an investor, since September. September 9th, that was my first investment in Opendoor. They've been nothing but transparent with the figures since then. They've adjusted their projections for their quarterly earnings and their quarterly revenue along the way a couple times as well to make it more accurate for investors leading up to the earnings call, which you love to see. I love transparent companies. Most companies out there want to do that. So when they say 625 is their projection, and they projected these outcomes essentially, like they projected their revenue to be slightly lower, like maybe like 100 million or so lower, back in September in their investor presentation, and they adjusted along the way, and it was $2.5 billion. It was straight, it was right on. So when they say 625, just based on their track record of me being an investor so far, I trust Opendoor's projections right now, and I have no reason not to. When you invest in a company that lies to you about numbers, they lie to you about projections, and their projections never hit, that raises room for concern where it's like, okay, what are the analysts saying? Oh, this analyst has been right when they've been wrong, and their projections every time. This isn't the case here with Opendoor. Opendoor is, I mean, I'm super biased, but they've been transparent. I got no reason to doubt them. They say 625, I'm banking on 625. If they update me later on and say that it's looking closer to 600 or 575, so be it. Just keep me in the know, right? If things don't go all perfectly according to plan, which they seldom do in running businesses, I think it's awesome that they keep their investors in the loop, and you don't see that with many companies. You don't see that with even with Luminar. I don't get updates like I do with Opendoor, and I love Luminar as a company. Yeah, when they say 625, I'm expecting 625, and I will be sure to update you guys if anything changes on my end or I have any reason to doubt them, but I don't. You in here at let's see, I'm trying to, was it Light Setterful? Is that how I say it? If you got 15,000 shares, you're sitting in a great position right now. I wish I could switch positions with you. I wish I could have your 15,000 shares right now, because this company's going to make me a lot of money. It's going to make you way more money than me. Just stay patient with them. This is the future. AI driven. Their AI blows Zillow's away. Is future looking, adding convenience in the age of convenience. People are going to pick this option over Zillow, over any other home buying option or home selling option. I guarantee that. The fees are also cheaper on Opendoor. You're looking at about 5% flat fee for selling your home on there. My mother's a real estate agent. I mean, she's about to retire, so it doesn't really affect her, but I asked her what the fees are as a seller of a home. She says on average it's about 8 to 10% is what the seller will pay at the end of the day. So that's with a bunch of fees factored in too, guys. I've been called on that before. I'm just telling you what I hear. Yeah, if you can not eat 8 to 10% and you can only eat 5%, that's going to be great. I've been buying since IPO B2. I'm a big Chamath guy. He's been someone I've been following since I got into entrepreneurship back in 2016. Huge role model. The dude's brain just works differently. Yeah, I was right there. I think my first purchase was like $11.63, but then I really started loading up around $14 and averaging up along the way. So right now I'm sitting at around $16 is my average hold on it. So we're both very fortunate, I'm sure, to get in where we did. This company, was just around $40 not too long ago, and it's going to be right back around $40 pretty damn soon. So hold on to your socks, guys. Buckle in. We are going for a ride. It's going to be fun. I don't know what date their earnings call is going to be, but I better see y'all back in here for their Q1 earnings report, because it's going to be so much better than Q4 earnings. It's going to be, I think we're going to see a big run up to that one, and I think that we're going to see them beat their projections of 625. That is my bold prediction right now. I'm going to go clip that, put it onto the TikTok and the SnapTube and the face chats, and show all my friends that I was right back in March. I've been right since September. Y'all have been right since whenever you got in. This company is phenomenal. They are not going anywhere. Hold on. It's going to be a fun ride, guys, and I'm looking forward to getting to know y'all every step of the way. I stream every single day. If you haven't already, please, please, please smash that like button, smash that subscribe button, and ring the little bell next to it so that you can get notified every time I drop a video, every time I go live, and we're making money up into his house, which is every single day the stock market's open. This channel is brand new. I came from Burner Market Trading. That is a partner of mine as well. You can check their channel out. For me, I've been making this call for a long time, folks. They've got way more subscribers than I did. I just started this channel this week, so they've got like almost 3,000 subs. I got like maybe 30. Right? If I had 30 by the end of the week, I'm doing really good. But no, I would love to get to know y'all better. Pop in here, sub if you haven't already. My socials are in the description below if y'all want to connect with me. Love getting to interact with my friends who I talk to on the stream every day. And yeah, if we're all in Opendoor, it makes sense that we get to know each other so that we can enjoy this ride while everyone panics because their speculative growth stocks are going to shit. And our speculative growth stocks are strong and they're underpriced right now. And they're only going up. And they're going to the moon. So let's load up on more in the meantime. But I'm going to sign off, guys. This is my second stream of the day. I've streamed for like 5 or 6 hours today. I'm pooped. Looking forward to meeting up with y'all again tomorrow, starting at 10:30 a.m. Central Standard Time. But yeah, it's been getting to meet some new faces in here, and I'm looking forward to getting to know y'all better. Y'all have a great rest of your day. Oh, all the way from the Netherlands. God bless y'all. Y'all have a great rest of your day. Take care, and I will see y'all soon.